Morning, and thank you for joining us today on our quarterly moat investing webinar as tech dominates, a counter to concentration risk. We've got a lot to cover today across the US equity markets and specific to the VanEck moat investing strategies that we'll touch on throughout today's presentation. So let's just jump right into it. We're very happy to have with us again today a great panel of experts from Morningstar. Joining us as usual, Andrew Lane, who's Director of Equity Research specializing in index strategies with Morningstar. Also joining us today again is Nick Owens. Nick has been a longtime analyst at Morningstar covering right now the aerospace and defense sector, a very newsworthy area of the market over the last several months with geopolitical events. And then Dan Wazelik joining us today for the first time, but a long time member of Morningstar's equity research team. Dan covers gaming, lodging, and online travel for the consumer team at Morningstar. So we're thrilled to have these Morningstar experts join us today, share their insights, not only to discuss what's driving strategy performance, but also bring to life Morningstar's rigorous research process and share some stock examples and some pretty cool opportunities within the various portfolios that we offer here at VanEck. Before we jump into some of our typical content, as the name of this webinar implies, we are all navigating really, interesting times in the U.S. equity markets. As I think most are familiar, over the better part of the last 2 to 3 years, the U.S. equity market has been driven by a few major mega cap companies, primarily from the tech sector. The Magnificent Seven, as they've been coined, and now there's many other acronyms that are starting to pop up as other companies that are benefiting from the AI trade and the massive capex that we're seeing across the market toward new technology. Many of these companies have driven market returns, and as a result have only gotten larger and larger on a percentage basis compared to other companies in the US equity markets. Look no further than the S&P 500, widely viewed as a broad-based benchmark for US equity exposure. We've seen the concentration within the S&P 500 in recent years spike, both in terms of market cap, and so the size of the companies, the largest companies, are now making up much more a percentage of the overall US equity market than they have in years past. But very importantly, from an earnings perspective as well, you're seeing earnings growth come from a select few companies within the market. And many investors have sat back and not only participated in much of that growth, but observed these concentrations and wondered when that breadth would kind of widen out throughout the market, when other areas of the market, from value stocks to smaller cap companies, will start to participate more meaningfully in the earnings growth that we've come to expect across various segments of the US equity market. So not to say that this market trend will end anytime soon. I mean, there's massive investment going into the AI to AI technology, broadly speaking, and that's benefited many companies in many different ways, and very, very well may continue to do so. But if nothing else, the trends in the market as of late should at least, I think, cause investors to stop and take stock of their portfolio, understand what they own, and understand that there may be opportunities to add diversification and the potential protection from unforeseen market turmoil or unforeseen corrections that we are growing more and more accustomed to in recent months. When you think about some of the most popular, most widely followed broad-based US equity indexes like the S&P 500, the Russell 1000 growth, and the NASDAQ 100, if you look at the top 10 holdings, what you see is you're going to see much of the same across all of these indexes. The same names, for the most part, occupy the top weightings in each of these index-based strategies. So when you look at the S&P 500, often thought of as a core US equity holding, holds virtually the same companies within the top 10 exposure that a more tech-oriented NASDAQ 100 index might hold. So finding differentiation in indexed portfolios or even actively managed portfolios is seemingly harder and harder to come by. And that's what we've been talking about with our Morningstar powered moat investing strategies for the better part of the last 2 years. It's really important as we watch markets reach new all-time highs with brief periods like we've experienced over the last several trading days of pullbacks upon global uncertainty and speculation around tariffs and other tensions in the world. A portfolio can certainly be very well served by adding some level of diversification, and that's what you're going to get from these Morningstar wide moat strategies, as you can see on screen right now, with a fully unique set of top 10 holdings relative to most major US equity indexes. To hammer home that point, if you look under the hood of these very widely followed large indexes, from growth to the Qs and the S&P 500, you can see that the percentage of those indexes that are dedicated to the very few trillion-dollar companies that we have here in the United States. We're talking about NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Broadcom, Tesla, and Berkshire Hathaway. Many of these indexes comprise upwards of 50% of their portfolio in these few large trillion-dollar companies. You have to start to look at a very differentiated index, those that are focused on maybe single factors like quality and momentum, to start to see reduction in that market concentration, tools that can add some diversification, yet still have very meaningful exposure to some of these large names. And so we think about diversification as markets reach these higher and higher levels. And not only do we think about diversification, but I think investors have to think about valuations and kind of where we are, where we may go from here, not only in the short term, the next quarter, the next year in terms of CapEx and AI investment and any risks that are inherent near term, but really with a longer term lens and a longer term perspective. Where the S&P 500 sat at quarter end as of 9/30 is really outside of the normal bands for typical valuations. We're looking at forward PE ratios of the S&P 500 historically, plotted all the way back to 1991, and then we think about forward returns from that point in time, from that valuation point. And what you can see is that when valuations are near 25, like we sit today, historically, when you look 10 years from a point in time when valuations were upwards of 23, 24 on a forward PE basis, we don't see many, if any, periods where 10 years beyond that valuation point, the US equity market posted a positive total return. So we're in a really unique period of time. A lot of uncertainty from geopolitical concerns and tariff concerns, paired with this massive investment in AI that has really boosted portions of the US equity markets, pushed them higher and higher. I think investors standing back, not necessarily concerned that the shoe will drop and the bottom will fall out and markets will correct significantly, but probably wondering how long of a support that the AI ecosystem can provide to broader US equity markets. So I think considering market exposure, considering your portfolio, understanding the concentration you might have across your portfolio, despite trying to own new tickers or new strategies that sound differentiated. Looking under the hood, you might find that you're owning a lot of the same, and that's really been a key point that we've been making as it relates to our moat investing strategies. And that's what we're going to talk about today. So we're going to talk about two indexes, flagship indexes from Morningstar, the Morningstar Wide Moat Focus Index and the Morningstar US Small Mid-Cap Moat Focus Index. These two indexes underpin two ETFs offered here in the United States under the ticker symbol MOAT for the broad-based flagship US wide moat strategy, and SMOT, SMOAT, the SMID-cap variant of this time-tested Morningstar US moat investing philosophy. And so I'm going to turn it over to Andrew Lane now, maybe to walk through, starting with the flagship US equity index strategy, some of the near-term headwinds that the strategy has faced, some drivers of performance over the last quarter, and anything else you'd like to share in terms of long-term performance for the strategy.
Sounds good. Thanks very much, Brandon. Yeah, so the Morningstar Wide Mode Focus Index has been around for almost 19 years now, since its live inception date in February of 2007. And so despite fairly significant underperformance, as Brandon laid out, since the beginning of the 2024 calendar year, the strategy has still soundly outperformed the broader US equity market since inception, as you can see on the right side of this slide. Now, the most recent Morningstar US Active Passive Barometer report from the Morningstar Manager Research Team indicates that over the trailing 10-year period, only 6% of active funds in the large blend category have outperformed a composite broad market benchmark. It's a figure that's, in my opinion, shockingly low. Of course, over the last 10-year period, the Wide Mode Focus Index has been able to do just that, again, despite recent headwinds. And as it pertains to these recent headwinds, that's really primarily been driven by the strategy's equal weighting mechanism amid utter dominance from the Magnificent Seven basket of stocks. And this has weighed heavily on both short and medium term results. If we think about the third quarter itself and zoom in a little bit, the Morningstar Wide Mode Focus Index again trailed the broader US equity market. And the drivers of this underperformance are really quite similar to those that have weighed on relative performance in other recent quarters since the beginning of the 2024 calendar year. And that's growth soundly outperforming value at a time when the index exhibits a modest value bias. And then again, the Magnificent Seven stocks performing very well. So when the Magnificent Seven account for a hefty portion of the broad market's total returns, that typically spells trouble for equal weighted large cap US equity strategies like the Morningstar Wide Mode Focus Index. Of course, that Magnificent Seven group of stocks now accounts for somewhere around 35% of the weighting of the S&P 500, but can never get close to that weighting in our index due to its equal weighting methodology. At best, we may have just about half of that exposure if we were to own all seven stocks at a full equal weighting. So as Brandon laid out during his remarks, this is one of the many reasons that the Morningstar Wide Mode Focus Index can serve as a really fantastic complement to broad market exposure, because it doesn't double down on the heaviest weighted holdings within the broad market and earns returns from other less appreciated corners of the market. If we can think about sector weightings in the third quarter, being overweight the consumer defensive and healthcare sectors weighed on performance, while being underweight the financial services sector was beneficial. And then for individual positions, there was a headwind from not owning four of those Mag 7 stocks, Alphabet, Tesla, Nvidia, and Apple. The index did hold a little bit of Alphabet, but we still are underweight versus the market. But being underweight those four stocks represented a pretty pressing performance headwind, again, as each of those outperformed the broad market. However, being overweight Teradyne and Monolithic Power Systems, two stocks I'll call out individually, both somewhat lesser known wide moat rated tech stocks, proved highly beneficial as both those stocks performed quite well. And then on the bright side, the index has gotten off to an encouraging start here in the fourth quarter. Well, it's still very early in the quarter, and we hope to maintain this momentum going forward. So on the following slide, this reflects what took place during the index's most recent reconstitution. I'll use this opportunity to remind everyone that the Morningstar Wide Mode Focus Index is reconstituted and rebalanced on a quarterly basis. So in other words, each quarter, the portfolio construction rules kick in, and through an entirely rules-based process, the most undervalued US wide moat rated stocks are prioritized for inclusion in the index. So it takes subjective fundamental research from our analysts and uses all of that valuable research in a rules-based manner to reconstitute that portfolio. Overvalued stocks are cycled out of the index each quarter in favor of more undervalued opportunities in the eyes of Morningstar equity analysts. So this was a unique quarter. When you think about reconstitution, the index removed and replaced 17 stocks in September, and that's a very high degree of turnover relative to what we normally see. I'd say normally you probably see more like 8 to 10 stocks getting removed and replaced. So we were double the typical degree of turnover in the third quarter. And if you take a closer look at the texture of this reconstitution, the index increased its overweight positions in the industrials, consumer defensive, and healthcare sectors, while materially reducing its exposure to the technology sector. These changes again restored tech as the biggest sector underweight. And again, industrials, healthcare, and consumer defensive are actually the three sectors that were overweight. Those are the only three overweights. We'd note that the index is typically underweight tech. Again, going back to that equal weighting approach that we leverage, it's just sometimes very difficult for the strategy to match the broader market's exposure to a lot of those large cap and mega cap tech companies that command hefty weightings in whatever cap weighted benchmark you'd like to use, including the S&P 500. From a style perspective, the index continues to exhibit a mild bias towards value at the expense of growth. And as for prevailing size, the index largely stays static and remains right on the border between that large cap and mid cap space. And interestingly, this again is about as small as the index really has ever skewed over its nearly 19-year live track record. That smaller than normal positioning stems in part from a sizable underweight across mega cap stocks like the Magnificent Seven, but more so from our view that small and mid cap stocks at the time being offer more attractive return potential than a lot of those large and mega cap opportunities out there. And as it pertains to individual holdings, 14 of the 17 outgoing stocks were removed due to valuation considerations. You can see here on the slide the price to fair value column. Each of these 14 stocks appreciated upwards towards our fair value estimate, or in many of these cases, above our fair value estimate. I'd note that the Campbell's company was removed due to a liquidity screen that we have in place as its market cap fell below the acceptable threshold. Well, International Flavors and Fragrances and Pfizer were both removed because their economic moat rating was downgraded from wide to narrow, right? And of course, a wide moat rating is a requirement for inclusion in this wide moat focus index. Otherwise, tech stocks dominated the list of removals. So we flip forward one more slide. Given that we see many attractive valuations in the small and mid cap space, we've been seeing some heightened interest in the Morningstar US Small Mid Cap Moat Focus Index. And as I always like to say, this SMID Cap Moat Focus Index has the same DNA as the Morningstar Wide Moat Focus Index, which just targets a different portion of the market cap spectrum. So very similar. It also screens for companies with durable competitive advantages that are trading at attractive valuations. And it's all based on the same fundamental research from our group of over 100 equity analysts at Morningstar. And we'll, of course, be hearing from two of these analysts here very shortly on some individual companies. So, while this SMID Cap index doesn't have the lengthy track record of the Morningstar Wide Moat Focus Index, it's also performed reasonably well versus comparable benchmarks since it went live in July of 2022, right? So now we're past a 3-year live track record. The best way to think about the Morningstar US Small and Mid Cap Moat Focus Index is that it provides exposure to the US small and mid cap space, but it has a focus on companies that generate more free cash flow, have higher returns on invested capital and stronger business models than the broader small and mid cap investment universe. So this makes moat investing particularly attractive in the current market environment, as companies with economic moats, regardless of their market cap, tend to have pricing power relative to companies that lack a durable competitive advantage. And therefore, they should be better able to pass on tariff-related input cost inflation to their customers relative to less moaty peers, if you will. And based on recent news events, it certainly seems that heightened tariff activity, whether in the form of actual tariff implementations or empty threats, are not going away anytime soon, right? And so moat investing, again, in this environment, I think makes a lot of sense. So in summary, the strategy represents a higher quality play in the U.S. mid-cap space versus the Russell 2500, as well as the index's Morningstar U.S. small and mid-cap parent index. So Brandon, I'll send it back over to you before we discuss some individual holdings from these two indexes that have impacted their recent performance.
Okay, great. Thank you, Andrew. Appreciate all those perspectives. What I didn't do at the beginning of the call, and I want to remind everyone now, is that you can ask questions. So please do in the Q&A window on your screen. If you have a question about anything we've covered or anything outside of what we're talking about as it relates to this particular discussion, please submit a question. we'll try to answer those throughout today's webcast. And before we jump into individual stock examples and dive into moat ratings and valuations, I'm going to ask you a question, Andrew, that was submitted before the webinar. So I'll jump back to the flagship Morningstar Wide Moat Focus Index. And this is one that you get all the time, so I'm interested to hear what you have to say. All right, how does moat, which is based on fundamental factors, react to momentum, which is currently favored by the market? So I guess the momentum impact on moat.
Yeah, absolutely. And so this sort of gets into the conversation of sort of, when does the wide moat focus strategy perform best? When does it tend to underperform? And one of the key elements that can have a big impact on performance is the performance of the momentum factor, right? So as you can imagine, for a strategy that uses valuation as a core determinant of when stocks go in and come out, we actually end up being very underweight momentum, right? So all 14 of those stocks that were removed due to valuation considerations, by and large, had established a very strong momentum loading, right? A high loading to the momentum factor. And so as these stocks perform very well and their momentum factor exposure increases as they appreciate, once they hit or exceed our fair value, they're very likely to be removed for more undervalued stocks. And sometimes those more undervalued stocks that replace them have traded a bit lower and come in perhaps with, a negative momentum loading. And so what I always like to say is that the index's consistent underweight exposure to the momentum factor is a necessary evil in order to ensure that we always maintain a portfolio of undervalued stocks, right? So over the long term, over the last 10 years, the index has traded on average at a 14% discount to fair value if you look at all the individual holdings. And the only way to maintain that discount to fair value and make sure that we're prioritizing undervalued stocks is to kick those stocks out that our analysts no longer feel are undervalued, right? And so that creates the underweight exposure to momentum. And certainly at times that hurts us, right? When momentum is performing very well, as it has been in recent quarters, that does usually provide a headwind. But that's also a reason that the strategy has provided a lot of downside protection when we've had downward volatility of the market over time. Is that underweight position of momentum tends to play very well when the market's on shaky footing, or we have a week, a month, a quarter, or a year where the market pulls back. The strategy usually has provided very nice downside protection in those environments.
Excellent, thank you, Andrew. All right, let's get into some company examples. Nick, I'm going to bring you in now to talk about Huntington, which has been in the portfolio for a little while now. This is an interesting one. I think anything in the aerospace and defense segment has a lot of dynamics, of course, with a government shutdown happening as we speak. You can't avoid talking about the influences on large government contracts and everything like that. So I'm going to turn it to you. Why don't you walk us through this company that some may not be very familiar with, what drives its moat rating, and where do valuations sit?
Thanks, Brandon. Yeah, Huntington Ingalls is one of the smaller defense contractors on my list. It's about a $11 billion market cap today. It was spun off in 2011 from Northrop Grumman, which is one of the bigger names. And what's really interesting about it is essentially a pure play maker of ships for the U.S. Navy. About 80% of revenue comes from building submarines and aircraft carriers and amphibious assault ships, and as well as destroyers, guided missile destroyers. And the moat rating for Huntington Ingalls comes from two main factors. That's the intangibles, which I'll go into, as well as switching costs. So in this context, the intangibles that Huntington Ingalls has, and this is somewhat common to a lot of the defense contractors. Basically, it's technical complexity. The Pentagon is asking these companies to go make something that has never been made before, a nuclear submarine that can go so many months underwater and has nuclear power and have so many people on board, et cetera, with stealth characteristics, et cetera. So the technical complexity, which really then also comes with the know-how, the people making these things have specialized skills, experience that allows them to build these types of systems. And in the very specific factor that drives the moat ratings on the defense contractors is this idea of switching costs, where you have the moments when the companies compete with each other to bid to become the next contractor for a certain program. But once those bids are awarded, and in particular in the case of shipbuilding, we're talking about multi-decade programs. The ships themselves will be at sea for decades. The family of ships, let's say that design might be at sea for 40, 50 years, as the case with aircraft carriers. And so once those are launched, the ability of the Pentagon to switch and say, oh, never mind, we'll change the design of the product is very, very low. What they will do is say, we want to update how this thing works or change the design, and they'll make adjustments to the design. But that's much different than saying, never mind, we're going to go get someone else. And in the case of Huntington, it has a monopoly or duopoly position in almost everything it does. In the case of nuclear aircraft carriers, it's the only firm that can build, fuel, refuel, and decommission those ships. And it shares with General Dynamics some of the other more common boat designs like nuclear subs and destroyers. So very, very strong competitive advantage and lots of visibility. In the context of my list of defense contractors that I cover, these programs, boats, have some of the absolutely longest shelf life, if you will, and visibility into how long it will take to build them and how much money the government has set aside in its budgets to pay for those. So in terms of valuation, it's actually been kind of ticking over nicely here in the last year or so, after, I would say, a crisis of confidence late last year around the company's ability to increase the profitability or productivity of its Newport News shipyard. And really what we're seeing play out is a kind of slow and steady recovery of a productivity in the Newport News shipyard that basically the market had essentially expected would all happen much faster. So in late 2024, there was hope that this company would sign a big blockbuster contract for 17 submarines that would allow them to update the amount that they can pay the people in the shipyard and have more flexibility in how they move people around from boat to boat. But that is not going to happen as one big blockbuster contract. Those are going to be signed sort of in the onesies and twosies with the Navy as they negotiate through the specific terms of those contracts. Some of those have already been signed here, and I would say there's not really high level disagreement between our thesis and the market in terms of what's going to happen with Huntington. It's just more a matter of when. So my fair value estimate reflects the present value of the cash flows that I think the company can produce, and we're really just sort of seeing the valuation grow into that.
That's great, Nick. Yeah, thank you. That just to, I guess, to hammer home the index methodology using all of your research, not only the moat ratings, but the index is a consumer, right, of your fair value estimates and the price that this stock is trading relative to fair value. So for everyone on the call, you know, while the chart only goes back 1 year, you can guess that Huntington Ingalls was undervalued when it was added in December of 2023, so shortly before this chart began, and then the position was actually scaled up in September of 2024. And then, while to Nick's point, there might be some short-term kind of dislocations in price relative to fair value based on more short-term expectations from the market, the hope for this rules-based index strategy is that the market will slowly realize, or maybe quickly realize, the undervalued nature of any given stock. So it now has crept up closer to fair value. So we'll see in future reviews if Huntington will remain in the portfolio. All right, Dan, let me bring you in now. We're gonna shift gears, head over to travel and accommodations. Airbnb, it's kind of a newcomer to the moat strategies. Maybe you can walk through the moat rating, that evolution of your moat rating, and where valuations stand in your view.
Sure. Thanks, Brandon. So Airbnb, as you're probably aware, is the leader in online alternative accommodation bookings. It is a wide moat company. The source of that wide moat is a network effect. So the network, you have the supply side and demand side. On the supply side, in this case, you have individual hosts and alternative accommodations. And as those are added, that enhances the value of the demand side, or in this case, users, because there's more choice for them. And then as more users join the network, that enhances the value for the individual host because there is more demand on the channel. Now, this supply and demand, on the supply side, Airbnb has a leading amount of listings at 9 million. On the demand side, it has a leading room night share of about 50% globally. Both of this supply and demand have been growing in unison, up about 50% each since mid 2022. And there's evidence that they're monetizing this network effect. We estimate ROICs for the company averaging in the mid 30s over the next 5 years. So you can see in the chart here that Airbnb, if you look at its recovery, it was the strongest travel recovery company out of the pandemic. In 2024, its revenue amounted to 231% of 2019's level. That compares with the US hotel industry that at that time averaged or recovered to about 115%. And so the last year, the chart has, kind of presented an opportunity for long-term investors for a couple of reasons. One reason is growth has normalized, which you would expect for Airbnb given its recovery, and this is something that's happened in travel. Also, there's been a little bit of economic uncertainty more recently, which Airbnb and the travel industry has noted. And additionally, Airbnb is making prudent long-term investments in international experiences and service markets that are hindering the near-term EBITDA margins. Now, investors, we think, are too focused on those near-term dynamics that I just mentioned and not focused that these investments are going to strengthen that network advantage and also in the intermediate and longer term allow for EBITDA margin not only to recover but to expand, we think, to all-time highs. So just quickly talking about we upgraded our moat from a narrow to a wide moat in March in front of these expansions. And just to highlight experiences or things to do, this is a $300 billion market. It's 30% online penetrated. It's highly fragmented. So the leader, Viator, which is owned by TripAdvisor, has only 1-2% share. And when you look at a company like Airbnb, it has a very communal culture. It has individual hosts that have a unique knowledge base of their locales. So we think they're going to be able to offer very unique things in this experiences market. And then that combined with services, which adds hotel-like amenities, allows them to be more competitive with traditional hotels. The combination of experiences and services, we think, can amount to around 10 billion in bookings by this end of the decade, or 6 to 7% of total bookings for the company. And then internationally, they have their mature markets of US and North America, but they've identified a handful of international markets that they want to build awareness in, build supply in, and that they think that over time, those markets will get to the same penetration rates as a US-Canada market, and that can incrementally add tens of billions in bookings. And so far, the initial markets that they've been investing in, Brazil and Japan, have shown very good, strong results. So we think that the near-term focus of the market on these investments, which strengthen the network advantage and will re-accelerate growth in the intermediate term, is what we're focused on and what's implied in our fair value estimate of 154. And the shares trade, we think, offer an attractive opportunity to trade in about a 20% discount to that fair value today.
That's great. Thank you, Dan. Yeah, this will be a fun one to watch. Very interesting, very new addition to the flagship Morningstar Wide Moat Focus Index, also new in the mid cap version as well. Again, just hammering home the long-term perspective that Morningstar brings to the table versus what tends to be much more of a short-term perspective in the market. So we'll see where where Airbnb goes from here. All right, let's hear from Nick again. And this is certainly not no shortage of controversy when it comes to Boeing in the marketplace. A lot of headlines driving the news cycle and the impact on the stock. But through it all, Nick, you've maintained a wide moat rating on Boeing. So why don't you talk about that and where valuations stand?
Yeah, you said it, Brandon. We live in interesting times. So we cover Boeing, obviously more of a household name here, one of the largest aerospace companies on Earth, and it basically occupies a duopoly with Airbus and large airframe commercial jets. Similarly to Huntington, in terms of the sources of moat, it's got intangible assets and switching costs, which I should sort of emphasize are still in place despite all the troubles that it's been going through. So in terms of intangibles, it's simply a very rare set of talents and facilities to be able to build these large commercial jets. Many have tried and to break into this market, not least Bombardier, to some degree Embraer, Mitsubishi Heavy, and it still is a duopoly. So we see that as an enduring source of competitive advantage. Even within, let's say, the execution issues that Boeing has had. And then the switching cost is an interesting one here. Airlines all over the world, and there are many of them, essentially have to buy the latest aircraft, which are usually 15 to 20% more fuel efficient than the previous model, because if they don't and their competitors do, they'll be at a permanent disadvantage. And so, and then within that, there's really only two shops in town, Boeing and Airbus, to get these planes from. And the planes fly for some 20, 30 years. So once they've bought the plane or leased it, et cetera, they're usually committed to it. And their family of planes that they fly is usually focus on one maker or another. So I would say there is flexibility among airlines to choose one or the other, and Airbus has been taking some market share, but in the medium term, these orders are very sticky. In terms of sort of valuation of what's going on with Boeing, what you really have here is a kind of delayed recovery. So they're in turnaround mode, new management, undoing some of the poor decisions that they had made back in 2018 and 2019 related to accepting fuselages that had defects in them for the 737. And they're under a very strict scrutiny by the FAA to prove that their manufacturing process is replicable and clean, and only when they can do that will they be able to increase the rate at which they build the 737s. Similarly, they're looking to increase the rate at which they can build 787s, and they are looking to certify the new 777X, which now it looks like won't happen till later this year, early next year, and so the commercial deliveries won't hit the ground until probably 2027. So there, I think you might see some of that in the most recent piece of the chart here in terms of people worrying about when those things will happen. We're confident that they will happen, and again, I emphasize, our fair value estimate is the sum of our future cash flows. So it's just a matter of when. A lot of investors had been on the sidelines around Boeing starting in say 2022 and onwards, just thinking, sure, they'll make it back, but when will that really start happening? When you see the quarterly results start to tick over with faster deliveries of these planes, that's when I think it will kind of appreciate more to our fair value and beyond. Yeah, they have a meaningful defense business and so forth, but at least half the franchise value for Boeing comes from the 737. So that's really what we focus on in terms of monitoring progress and so forth. Back to you, Brandon.
Yep. Excellent. Thanks, Nick. And we mentioned, I think in the notes here, so it's probably worth pointing out the reduction in fair value estimate by $3, which occurred in October, which falls just to the right of the right side of this chart. So you don't see that reflected here, but a modest reduction in fair value as discussed, which doesn't quite show up in the plots here. But
yeah, that's just pushing out that 777X by a couple of months.
Yep, exactly. Perfect. Okay, excellent. Well, thank you for your take there. And then Dan, our final company of the morning, DraftKings, which depending on your demographic, you're either maybe very familiar with or a little less familiar with, but I venture to guess most have seen commercials on whatever programming they may watch during the day. So what can you tell us about DraftKings?
Yeah, DraftKings, thanks, Brandon. DraftKings is a leader in U.S. online betting and also online iGaming or casino markets. It is a narrow moat company. The source of that narrow moat is a brand intangible advantage. And really what drives that brand advantage are two things, product development and risk management tools. So on the product development side, DraftKings really gained an advantage by being a first mover in fantasy football, which gave them millions of users as sports gaming was legalized on the state level in 2018. And that gave them the initial scale that allowed them to have the means to invest into further product innovation, such as being one of the first to offer products such as parlay bets, which are very popular in the US. On the risk management side, so having all these users and the data and the scale allows them to price odds more accurately than the competition, which improves the user experience and also allows them to have a stronger margin that gives them the ability to invest more promotion dollars into getting more users than the competition. And so it kind of is this positive virtuous cycle that this risk management tools allow more better user experience, more scale to reinvest back into and get more users. So that is the source of the brand intangible advantage that DraftKings has. Now, the stock has been on the volatile side. From a longer term perspective, the U.S. sports betting and iGaming market is a very attractive market. It measured at 22 billion in 2024. We think it's going to grow to 56 billion in 2030. Not only driven by new states adopting legalization, but the older states continue to grow. So the first states that legalized in 2018 sports betting still are growing low double digit on a revenue basis. Again, DraftKings is the leader here. But I think what the market is concerned on two levels is regulation and competition. So let's talk about competition. We've had some notable new competitors enter the market. ESPN in late 2023 and Fanatics with an acquisition of PointsBet in 2024. And then more recently, Kalshi. Let's talk about all those. So as those individuals have entered the market, DraftKings share has remained stable and has remained top amongst the market. ESPN, Fanatics only been able to kind of get to that mid-single digit share level, which we think is taking share from smaller competitors that have dropped out, such as Wynn. And then when you look at Kalshi more recently, you can see all the way on the far right, there's been a recent drop in shares. So Kalshi runs a predictive sports event market that allows sports betting. We think that this is probably expanding the market more than it is cannibalizing. And the reason it's expanding the market is it allows individuals that are aged 18 to 20 to bet on these sports contracts, which is not the case with traditional online sports betting. And also allows that to occur in states that aren't legalized, such as California and Texas. So we think that it's expanding the market, but maybe taking some share again from smaller competitors. And DraftKings and its peers will probably get into predictive sports betting, and it also probably will push those states that haven't legalized yet, like Texas and California, to legalize, which will help DraftKings in the end. So we have recently reduced our fair value to $51 per share to kind of incorporate the longer term risk from predictive sports betting markets. But still, this is offering a large margin of safety, we think, for long-term investors. It's currently trading at about a 35% discount to that fair value estimate. So on the regulatory front, real quick, the most mature markets, UK, Australia, are highly regulated, but the leaders in those markets are able to produce EBITDA margins in the low 20s. So you have DraftKings, which had a 4% EBITDA margin in the US markets in 2024. We think that can get to the mid to high 20 EBITDA because the US markets are several fold the size of UK and Australia. So even under regulatory scrutiny and regulations, there's still a lot of room here for EBITDA margin expansion. Back to you, Brandon.
That's great. No, thanks, Dan. 2 points. One, just clerical, just like on the last slide. As you mentioned, you've reduced your fair value to $51 per share, which is not reflected in the chart on the left. But I'd also highlight one other thing you said, which I think is really important in this context, because when it comes to gambling and the prediction markets, and there's a whole regulatory regime that it seems to be allowing certain quote unquote betting, sports betting, occur outside of the traditionally state regulated gaming industries. It's kind of thought of in my mind as just a disruptive technology, and that's really important in the context of moat ratings. So it's it's great to hear that's you're obviously considering competition and new technologies and different venues, and in the very specific case of DraftKings, an expansion of a potential client base, some competitive pressure as opposed to purely stealing share from DraftKings from these prediction market platform. So very, very interesting to hear that perspective as well. So thank you for highlighting that. So we've covered so far some what I think of as unique risks to portfolios in the marketplace right now. The concentration that we're seeing across all U.S. equity investments, generally speaking, outside of a select few, all owning many of the same companies and owning those companies at size. We've talked a little bit about how those dynamics in the market have impacted some of the moat strategies, both in the U.S. wide moat strategy as well as the mid-cap version, some shifts in portfolio exposure. Then, of course, we heard about some really unique valuation opportunities in the marketplace right now. And I just would take this moment to remind everyone that not only do we have a U.S. ETF, MOAT, that tracks the flagship Morningstar Wide Moat Focus Index, but also a mutual fund with both retirement shares as well as institutional shares geared a little bit more to tax advantaged clients. We also offer, beyond the mid-cap strategy, we've got value strategies for Morningstar International, so ex-US, and then global, where you can kind of combine that global, both developed and emerging market exposure in your portfolio. So plenty of offerings, lots to cover as always. So I will always remind everyone on these calls, please subscribe to our insights at vaneck.com/subscribe. You can sign up to receive any and all Morningstar content that we put out to try to better educate you on what you're owning and why you're owning it when you invest in our Morningstar powered ETFs. All right, so with that being said, I mentioned a few moments ago to submit any questions you might have. So I do see one in the queue that I'm going to take, and Andrew, you're more than likely to chime in here. If anyone else has any other questions, please don't hesitate to submit them. This one came from Miles, asking if the Russell 2000 is a reasonable benchmark for our SMOAT ETF SMOT, the mid-cap index-based product, because small caps have performed pretty well, particularly over the last 3 years and year to date relative to the index underlying SMOT. So I'll take a stab at that in terms of benchmarking these strategies. This can be difficult because these are somewhat contrarian strategies that give you very differentiated exposure, but you have to measure it against something, and that's obvious. What I will say about the mid-cap strategy, inherently, it tends to have a bit of a mid-cap bias. So when you look at broad-based mid-cap indexes, think of something, not the Russell 2000, which is small cap, or the S&P 600 small cap index, but if you think about something like the Russell 2500, which is their combination of small and mid-cap stocks, those tend to have a bit of a smaller cap bias relative to the index underlying our SMOAT ETF. So comparing it simply to a small cap index, or even what are billed as mid-cap indexes, tend to compare it to a smaller cap profile. And admittedly, the SMOAT underlying index does have a bit more of a mid-cap bias or posture, based on the fact that to earn an economic moat rating, generally companies tend to be bit more established and tend to be a little larger in market cap as opposed to the smaller cap companies. I personally tend to like to compare SMOAT to a small and a mid cap index, or a combination of the two, but it just helps to contextualize what's going on from a market cap perspective in the US equity markets. If small caps are really popping because interest rates are about to be cut, or some sort of growth news comes out and it looks bullish for small caps, you'll see a pop in small caps, and you'll see how SMOAT might perform relative to both small and mid caps over different cycles. And very often, the combination of mid and small have outperformed both small and mid on their own. So from an indexing perspective, the Russell 2000 might not be the most appropriate benchmark for SMOAT because of the mid-cap exposure it offers, but there probably isn't a perfect fit benchmark for this particular strategy. Andrew, you came off mute, and I never shut up, so maybe I will here and let you chime in.
I would just add that, you know, for a stock to be included in either of the indexes we talked about today, it has to be covered by a Morningstar equity research analyst, of course, right? So we have to have an economic moat rating, we have to have a fair value estimate by way of you know, a detailed discounted cash flow model. Morningstar's equity research coverage tends to skew larger relative to smaller. So that's probably one reason that the mid cap moat focus index tends to skew more towards mid cap than small cap. But the other reason is that when we do identify, you know, small cap companies with economic moats, well, what that really means is if they have a moat, they're earning returns on capital safely above their cost of capital, and we expect that to persist for long into the future. And so those are the types of companies that typically find their way up. They move upwards on the market cap spectrum, right? So a small cap company with a really strong moat typically doesn't remain a small cap company for long, right? It sort of matriculates up the cap spectrum. And so there's this sort of natural rising tide from a size perspective when we're identifying small and mid cap companies with moats. And so again, that's sort of the reason that the mid cap moat focus index tends to favor mid cap companies over small. You know, however, there are still many, you know, pure small cap companies in that strategy. It's not a mid cap solution. It is truly a blend. It just sort of has a little bit of a bias towards that mid cap space relative to small.
All right. Thanks for that, Andrew. And that wraps up all the questions. So we've covered it all. So with that, I think we'll conclude today's webinar. Let me thank you, Dan, Nick, Andrew, for joining us today. As always, we love hearing directly from Morningstar's equity research team and what you're thinking about and what's affecting your equity research on a regular basis. So thank you all for joining us.